Alright, so that is what is stated in the slides as well. The operating cash flows followed by the terminal cash flows, and then we move on to the next part where the question move us. So we have completed the first part of the case study. Then let's move on to the second part where the question asks, Allied uses debt in its capital structure, so some of the money used to finance a project will be debt. Given this fact, should the project that cash flow will be revised to show projected interest charges? Alright, so basically they're saying that do we have to include interest charges here? Since we only have taxes, we don't include interest. So class, what do you think the answer is? No, dividends nor the interest expense should not be included in the analysis. Alright, so you don't include the financing effects. Financing effect have already been taken into account by discounting the cash flows at 10% WACC. Alright, your cost of capital is already assigned for you to calculate the present value. So therefore, when you minus the interest expense or dividend, it's become double counting. Alright. And then the next question, should a 50,000 improvement cost from the previous year to be included in the analysis? Alright. Suppose you learn that Allied spent 50,000 to renovate the building last year, expensing this cost. Should this cost be reflected in analysis? Class, what do you think? Relevant, irrelevant? Improvement cost is a sunk cost. You already spend it. Whether you're going to be using the building or not, it's no longer relevant for the new project because you already spent it. It's a sunk cost, right? So this analysis incurred only incremental investment. See, suppose you learn that Allied could lease his building another party to earn 25,000 per year. Should that fact reflect in the analysis? If so, how? So class, what do you think this 25,000? What type of cost? This is it the externalities? It is the opportunity cost. Alright, instead of using the building, if you lease it, you could have earned 25,000. So you're losing this opportunity because you're using it for the new project, right? So yes, by accepting the project, the firm forgoes the possible annual cash flow of 25,000, which is the opportunity cost. Alright, so you will basically the 25,000 minus the tax, so your net opportunity cost is 15,000. So you include that in your cash flow calculation as well. So assume the lemon juice project should take profitable sales away from your fresh oranges business. Should the fact be reflected in your analysis? If so, how? So class, this is what we call as externalities. Alright. Net cash flow loss per year on the other lines would be a cost for this project. So the loss, alright, the loss because of the new product, alright, new line of products we have released, the loss becomes a cost for the project. Externalities can be sometimes positive, alright, sometimes it can give positive effect. Let's say your lemon juice becomes so popular until people get to know that, oh, do they have, maybe because of that they try orange juice. Alright, so it can be positive and also negative because it becomes a substitute. instead of choosing orange juice, people now take lemon juice. Alright, so complement becomes positive, if it's substitute it becomes negative. Alright, so that's done with number 2. Alright, so disregard all the assumption from part 2 and assume there is no alternative to use for the building over the next 4 years. Now calculate the project's NPV, IRR and payback. Alright, so don't just include anything. With whatever you just calculated with the existing computation here, the question asks you to calculate NPV, IRR and payback. So as you can see over here, once you calculate the net cash flow, the next part would be straightforward, right? So how do you calculate the cash flows for cumulative cash flows for payback? So 260,000 is your net cash outflow, initial investment minus this. You still need to recover 180.3. In year 2 you still need to recover 89.1. In year 3 you still need to recover 26. You only recovered in completely in year 4. So you need to calculate how much was the exact time you recovered. So 3 plus 26.7 divided by 89.7. First you'll get the exact. And then you have MRR and IRR calculations. By now you're already well versed, right? So you already have the cash flows. Next you calculate your IRR. So you should be getting plus. Try it out and make sure you get NPV equals to -4, IRR 9.3, MRR 9.6, and payback 3.3 years. Alright, so make sure you try this. Alright, so let's move on to the next portion of the chapter, which is types of project risk. You have standalone, you have corporate, you have market risk. So let's look at standalone risk. Is a project's total risk if it were operated independently. Okay, standalone risk, talking about if let's say a company has existing business, then now they're doing a new project. Standalone risk means whatever risk that you're getting from the new project, only that is called standalone. If you don't include your existing business, you don't include your entire company or industry, anything, you're just looking at that specific project, what is the risk? That is standalone risk. Usually we use standard deviation or coefficient of variation. However, it ignores firms' diversification among projects and investors' diversification among firms. See, for example, if you take Sunway Group, under Sunway Group you have colleges, education line, then you have hospital, then you have what do you call Sunway Pyramid, Sunway Lagoon, and so many things. If you just take Sunway Lagoon and you calculate Sunway Lagoon's risk, right, that is called standalone. You just want to know what is the risk in that particular company, Sunway Lagoon. So that is standalone. Alright, so the problem with standalone risk is it ignores firm's diversification. You see, even if Sunway Lagoon is not doing well, Sunway Pyramid, Sunway Sunway College or the Sunway Hospital, they're still doing well. Alright, so it ignores the firm's diversification. Let's look at corporate risk. Project risk when considering the firm's other projects. Diversification within the firm. So this we're talking about the entire Sunway Group, and see overall how the company is doing, because you're considering all the projects. Corporate risk is a function of the project's NPV and a standard deviation and its correlation with the returns of other firms' projects as well. See, for a market, you think the project has a well-diversified investor. Alright, well-diversified investor means they don't invest in a single project. They have invested in multiple projects. Theoretically, it is measured by projects beta and considered both the corporate and stockholders diversification. So which types of risk is most relevant? Alright, the market risk is the most relevant for the capital project because management primary goal is shareholders wealth maximization. Alright, just not standalone risk. Shareholders don't concern about one particular project. They're concerned about the entire business, entire umbrella, a group of companies. So they want to know overall how the company is doing, not just one single entity. However, since corporate risk affects creditors, customers, suppliers, and employees, it should not be completely ignored. Okay. Alright, so corporate risk means we are talking about the company's point of view. If the company's point of view, basically they have creditors, customers, suppliers. So you cannot totally ignore the risk that arising from a company. Alright, market risk is overall all the market. Okay. So which risk is the easiest measure? Of course, standalone, because you're looking at one particular project. So since your focus is easier way of evaluating. But focusing on standalone risk is not theoretically correct, but it does not necessarily to poor decision as well. Are there three types of risk generally highly correlated? Alright, yes. Market risk, corporate risk, standalone risk, all of it are correlated to each other. Alright, because since most projects of the firm undertakes are in its core business, standalone risk likely to be highly correlated with the corporate risk. Alright. If just take Sunway Group, if one project, Sunway Lagoon, is not doing well, it will definitely affect the overall company, right? In addition, corporate risk is likely to be highly correlated with market risk. If like the overall market is not doing well, in the entertainment industry is not doing well, definitely the company will be affected as well. So what is sensitivity analysis? It's a measure of the effect changes in a variable on the project's NPV. Alright, we want to know how sensitive is a project. If let's say the revenue drop by 10%, am I still gonna make profit? If yes, if no, it's definitely going to impact the business. What about my costs? If my costs increase by 5%, will I still make profit or loss? If yes, then your cost is more sensitive than your revenue. Because revenue drop by 10%, only you're making loss. But cost increase by 5%, you're already making loss. Right? So those are sensitivity. Which a variable that is more sensitive. So you have to make sure it does not change. To perform sensitivity analysis, all variables are fixed at the expected values except for the variable in question, which is allowed to fluctuate. So if you want to calculate the sensitivity of revenue, we will assume costs, expenses, taxes, finance costs, everything is fixed. So we just change revenue and see how it impacts the profit. And that is how we're going to be doing for every single item. Cost means the rest of it is fixed, and then we find out by how much the overall profit changes when we change the cost. And the resulting changes in NPV are noted. So what are the advantages of sensitivity analysis? So it identifies variables that may have the greatest potential impact on the profitability and allows the management to focus on these variables. You see, if you calculate the sensitivity of each product, it could be the selling price of a product, it could be the units you sell, it could be the overall revenue, it could be the cost. So let's say find out that one particular item like selling price, now you're selling for 2 ringgit. If you reduce the selling price to 1 ring 80 cent, you might be making loss. So that means it's very sensitive. Alright, so you will make sure the price does not reduce, right? So it does not reflect the diversification. We are only focusing on single project. So the effect of diversification for the entire company might not be reflected. Does not incorporate any information about the possible magnitudes of forecast errors. Alright, see, just now we did the entire cash flow estimation. In the applied food products, everything there is basically estimation. We estimate we're going to be doing the project for 4 years. We estimate the cost going to be 60% of sales and so on. It's all estimation. If your estimation is incorrect, alright, the estimation is totally incorrect, then definitely it's going to be affect the project, right? So sensitivity does not add all those into consideration. Alright, so let's do a scenario analysis. We have three probabilities. One is best, base is like normal, standard, and worst. And these are the probabilities: 25 chance, 50% chances, again 25% chances. So if worst case, you only sell 75. If normal, you sell 100. If best, you can sell 125,000. So all the factors shall remain constant, and NPV under each scenario can be determined. Right, so we are finding out that worst case your NPV is negative 27.8, base positive 15, best is positive 57.8. So what we do is, using that scenario, we want to calculate what is the expected NPV, standard deviation, and also coefficient of variation of NPV. So with all the different scenarios, alright, was norm, the best, and with the respective NPV, we want to know what is the expected NPV. Alright, this is the expected NPV. As you can see, when it's worst, 15 is base and best. So probability times the NPV, add up all together, that is your expected NPV. It's just like we did previously, right? Expected return. It could be from a percentage. Right, so this is the same method. Probability times return, add up all together, you get expected return. So expected NPV equals to 15, and your NPV return minus expected return, the whole thing square, times with the probability. Alright, so return minus expected return square times probability. You do all that together, then when you do all this, you get, if you remember, the one in the bracket is equals to variance. Square root the variance, you get standard deviation, right? And your coefficient of variation would be standard deviation divided by expected return, therefore 2.0. Alright, so for every dollar you spend, your risk is twice the amount. Alright. So if the firm's average projects have cash coefficient of variation of ranging from 1.25 to 1.75, would this project to be high, average, or low risk? So what do you think? This project definitely be high risk, because the normal range is 1.25. When you spend $1, your risk is 1.25, and until 1.75. This is the normal range, right? But now yours is 2.0, so it's higher than the normal range. So definitely it's a high risk project. So perhaps some sort of risk correction is required for the proper analysis. Right, so we have completed our chapter on cash flow estimation and risk analysis. Class, you make sure you attempt this yourself. Alright, maybe you later on you take out a piece of paper and start redoing the whole case study and see whether you're going to get it correctly or not. Alright, so we are done this chapter. Thank you.